Welcome to Stock Cheat Sheets, where we trend, rank, and grade stocks and exchange traded funds.
There I am, Mike O'Connor here with your weekly update, Stock Cheat Sheets at Substack.com, where we trend and rank relative strength and trading signals on the major index ETFs and sector and subsector ETFs. And for premium subscribers, we add a bunch of stock watch lists. I'm actually going to give away a really good, fundamentally solid S&P 500 stock watch list as part of our cheat sheet freebies this week. All right, let's get right to it. Just want to center everybody in time and space. You know, we've been focusing a lot on the minutia lately, and I think it's always good to have a little getting our chopper above things and see what's really going on. So I'm going to give you the vortex of death here. You should be able to see my screen here. Let's start with the price of oil. So if you remember, shortly after the Russians invaded Ukraine, we had a series of spikes in oil. The first one was here, and then we settled back down, and then there was a kind of a secondary run, and then we've been downtrending for 4 months. Well, that all ended, and that actually ended well before the Saudis gave Joe Biden the middle finger, and OPEC, of course, decided to cut production by 2 million barrels a day. Demand has been running hotter, prices are higher, supply is tighter, and all of those things. And, you know, there's some self-imposed limitations here in the U.S. in terms of our ability to increase output. And all of that has resulted in a oil breakout of diagonal resistance here. We've been just going and going the last few days, and a big candlestick on Friday. Not quite up, maybe not up to a resistance level, but we closed at our highs up almost 6%. So energy looks like it's going to go higher. And listen, the cheat sheet review I'm going to do for you today is basically a one-trick pony. It's all about energy. That's the only thing bullish in the stock market world. And of course, a reminder of what kind of pattern is playing out here. And I'm going to actually do this on the monthlies so we can get some perspective. I think I've written about this. It's called a megaphone pattern before, and that's where the upper and lower bounds of the indicator sort of start spreading. Now, typically a megaphone pattern is a sideways pattern consisting of a series of higher highs and lower lows, both at the same time. This one, of course, is a descending megaphone, but the trajectory is still the same. The point of this price pattern is that when it breaks down, and right now this is the wide, I'm going to just kind of scroll in so it's easier to see. This is the widest point of that. I kind of blew it. Let me try this again. Let's see if I can get a better look at this. Maybe the 3-year weekly. What do you think? Yeah, that's a good look. All right, so you can see we've been making a series of ever expanding higher highs and higher lows. Lower lows and higher highs within the context of a downtrend, forming this megaphone pattern, this big bullhorn pattern. And we're about halfway through the current leg down, where we're projected to touch the lower boundary somewhere down here at around 3,000 or so. Now, the point of this pattern is that you can certainly trade bound to bound, but one of the big kind of really ominous things about this is what it portends if we break, and that is that you can draw a line from the highest point of the megaphone to the lowest point. And so take, for example, 4,200 to 3,200, about 1,000 points here. And if we break down out of that, you can basically project a price target based on the width of the megaphone. And that puts us down here. And of course, this would require that prices absolutely just collapse horizontally, vertically, which is unlikely to happen. More likely that this megaphone pattern plays out and gets wider. But that puts us down at 2,200. And that means a peak to trough decline of, roughly speaking, 4,800 on the S&P to 2,200. That's like 60%. And that's really quite possible. So I'm not going to be the YouTube pessimism pornographer that talks about sell everything. People have no idea what to expect. You've seen some of those YouTube headlines. Get out while you can. Get out now. The collapse of the super bubble. But unfortunately, the data is reflecting the potential for a significant drawdown. Now, here's the good news. The good news is we haven't gone anywhere in 4 months, right? We hit our lows. We tried to breach the lows a week ago last Friday, and we got out of it and rallied hard. Bear market rally. I think we all knew that was a bear market rally. I kind of hit our head on this diagonal line where I'm trying to connect all the touch points here, and down we came. We did not break this kind of new lower. I don't know what you want to call this thing. I mean, this was support right here, but I think support is an area. We're kind of in the area of support, and we didn't break it, but we did have pretty decent volume. And but the good news is we didn't go out on our lows. They didn't just puke stocks up into the close. There were some buyers that came in very last minute. And how do I know? Because our trusty market forecast tells us. And this is one of, I think, the most important indicators. This is factor 10 on cheat sheets, the momentum line of the TD Ameritrade 4-factor market forecast. Remember, these are just different. These are oscillators that represent different time frames. So what's an oscillator? In this case, it's a 0 to 100 sort of scale of momentum. And the higher the number, the greater the momentum. The lower the number, the worse the bullish momentum, the more negative the momentum is, I guess is another way of saying it. So you think of it in terms of acceleration. So if price is velocity, meaning, we're running up or down in price, think of these oscillators in different time frames as representing velocity. So the idea here is you can extrapolate. If a line, for example, is just tearing it up near 80 or 100, that means the trend is accelerating to the upside. And we can conclude that based on the fact that a car that's accelerating, after a certain period of time, it's likely to be going faster, right? After it accelerates, it's going faster. So that's the idea behind these oscillators and why they're considered a market forecast, is they are projecting momentum in different time frames to give you an idea of what the trend is likely to be. And there's 4 of them here, and how these 4 interact really can set up some great trading signals and ways for you to think about the market. Now, we're not going to get into that per se here, but I just wanted to review what these timeframes represent on cheat sheets, because it's important. So the longest time frame is what we call market sentiment, or the long-term market forecast. That's this yellow line, and you'll notice that it's sort of a lagging indicator. So we had our big summer bull market rally here, and that was enough to get this long-term. I think I can. It's like getting a train going uphill. It got going and actually almost broke above 50, meaning it went from the defensive part of the football field on the 0 to 100 scale to the offensive part of the football field. But then, of course, price rolled over. You notice that this is a lagging indicator. Price rolled over first, and that eventually got this thing to roll over because the downdraft in price has been so persistent. So that's one time frame. It's the slowest. It averages about 9 months in a cycle. And what does that mean? It means from the time that it gets above 50 to the time it would return, get below 50, and get above 50 again. So in other words, a complete cycle, where we use 50 as the breaking point, above or below 50. So it goes below 50. How long does it take for it to cycle back up above 50 and then go below 50 again? On average, that's about 9 months. But when the Fed is either doing quantitative tightening or easing, we know about easing. We're not sure about tightening yet. That this oscillator can last 2 years. So it can last 2 years to the upside when the Fed is buying bonds and other securitized assets like mortgage-backed securities, and God, I think it even bought corporate debt during this COVID pandemic version of quantitative easing. But my point is, we're now going through something called quantitative tightening, and it's very possible that we will see a prolonged market sentiment run, meaning this long-term market forecast line. This could be a year or 2 instead of the typical few months. So just be prepared for a potentially persistent downdraft / sideways to downdraft. There's probably going to be fits and starts here. And we're in the middle of, I think, a fit, and we may be getting ready to finally get our next leg down. There are some signs that that's going to happen. Let me go back now to the, let's go back to the daily look. Of course, the We had this summer rally, and for a brief period of time, the 10 exponential moving average daily crossed above the 40. That didn't last. We're now back in a downtrend. This is my classic trend marker. When the green line is below the red line, that's a 10-day exponential moving average below the 40. So we're bearish, making a series of intermediate term lower highs and lower lows. And here we are at that key line in the sand. We thought a week ago Friday that, sorry, Joe Biden, I hate to steal your Armageddon word, but Armageddon was here. And then a mysterious bond buyer. I think there was probably some government manipulation going on that we suddenly, right at the point of breaking, we had this humongous 2-day rally. It didn't last. Hit our head on diagonal resistance, and now we're right back here again. But you'll notice that we did not close in what I'd call disaster territory. That momentum line, factor 10 on cheat sheets. Remember, when it gets below 5, we plug in something called danger zone 5. That simply means that the momentum was horrific going into the close. That usually portends follow through. So one of the things that we look for on cheat sheets, my eyes always go to factor 10, momentum. I want to see it preferably above 10. And now it did finish below 10, but not below 5. And the near-term line, factor 9, these are the two junior timeframes that help us forecast what's next. This junior oscillator didn't get below 20, which is sort of its line in the sand. And consider it was a 100-point down day. I'm fairly impressed that these oscillators hung their head above their kind of line in the sand for bearish follow through. So what does that mean? It doesn't mean much beyond the fact that I'm fairly confident it's going to take a little bit more to break us down. I just the way we finished, barring new information that surprises the market, and God knows what's happening over in Ukraine this weekend is certainly sets up the potential for new information that could send the market in all sorts of directions, but more likely down. Assuming nothing horrible happens over there, we're likely to putter around. We've got some big economic data reports coming out. And that's the other reason why I think market participants didn't totally collapse this thing. We have probably the most important is going to be the CPI. That's the most watched Fed index, the consumer price index. It's basically our inflation gauge. That's next Thursday. We also have the producer version of that. So that's more of a leading indicator, producer price index, which speaks to businesses ordering their inventory and, whether they're paying more for it or less and how much they're ordering. And then the consumer version is going to be more of a look back. But this is the big key inflation metric. And then later that week, we'll get more of the bad news, good news, bad news routine. Like, for example, the jobs report this past yesterday, that was good news, right? We added over 200,000 jobs to the economy, but no, it wasn't, because if you're a Fed watcher, we're not supposed to be adding jobs right now. We're supposed to be collapsing the economy for a soft landing, right? We're supposed to be crashing housing prices. We're supposed to be kicking people to the unemployment line, and all of that is supposedly going to bring down the price of a cup of coffee at Starbucks and mortgages back to eventually, something reasonable instead of the current 7 or nearly 8% that they're tracking at. So the market is not softening. The economy is not softening as fast as participants would like, because they need to see substantial softening to have any confidence and faith in a Fed pivot. And the Fed folks are out there again talking about inflation is really going to be a battle, and expect higher rates for longer. And now you've got a growing chorus of market participants that are thinking that's a disaster. They're not paying attention to the fact that the economy is softening and that we are going to force ourselves into a really hard landing. And that debate is just going to grow and grow and grow. And with it, probably the S&P 500 volatility. Now, the other thing that's going to start happening is we're heading into earnings season. I think banks are going to go first. And they're always a interesting tell because of the amount of analysis they do for other companies. So their forward guidance tends to be among the most valuable when you have the Goldman Sachs's and the JP Morgans of the world commenting on their potential future performance. It's going to be in the context of all the companies they analyze and the macroeconomic trends they see. So how they guide is really going to set the market up. So listen, we're either going to maybe have a Santa Claus rally, or the culmination of all of these different disparate data points are going to paint a picture that things are worse than they appear today, and therefore more selling needs to take place. That's sort of my thesis. But then the Fed is a wild card. I just don't trust them not to pivot. And I think that basically there's two buttons at the Fed desk right now. There's the hyperinflation button, right? When markets are collapsing, we can't afford to have tens of millions of Americans who are all at retirement age losing their stock market portfolios. So let's buy some stuff. And that's inflationary, right? And then the opposite, of course, when they're trying to fight inflation, they need to crash the various markets and people's portfolios along with it. So we have hyperinflation or Great Depression. Hyperinflation, Great Depression. Those are the two buttons. Those are the tools in the toolbox, and I have no confidence in their ability to engineer anything approaching. I mean, this is so stupid, right? What are we doing? This is not. We've somehow become a centrally planned economy. So anyway, I'll get off my soapbox. But that's what we're up against. So that's just what I think, and everyone has their opinion, and they're all on YouTube with sensational headlines to try to get you to click over and buy their newsletter, right? So in that spirit, since I've got a newsletter for sale, let's go to the cheat sheets and see what we got. Actually, I prepared my Substack blog already. I just got to find it. There it is. All right. This makes it easier here. So there's kind of two things that I like to provide, mostly for free, by the way. Free subscribers at stockcheatsheets.substack.com get at least 3 reports a week, absolutely free, where we track on the weekends, we track the relative strength trend of key indexes, sectors in the U.S. economy and subsectors. And we also track trading signals on the major ETFs that are associated with major world global stock indexes, bond indexes, currency indexes, commodity indexes, and then we get into sectors and industry groups in the US. And that's the free stuff. And then for premium subscribers, for like $5 a month, we'll give you cheat sheets for commodities, for fixed income, for I go through and do a fundamental analysis of stocks once a week and find the fundamentally best 20 stocks out of 500 with the best chance of appreciating. I subscribe to several different analytical tools, including Chaikin Analytics, though let me be clear, I do represent Chaikin as an affiliate marketer in another program, but I do not steal Chaikin data. But I incorporate it along with Fidelity and TD Ameritrade both have their in-house research. I go through all the stocks and I come up with a work list of 15 to 20 stocks that I think are just, they're making money. Analysts are upgrading them, bringing up their estimates. Insiders may be buying. The company management is making their earnings pretty consistently. And the stocks aren't overvalued. And we're using price to sales ratio, not some gameable financial metric. So price to sales ratio is essentially the price of the stock versus the top line revenue that a company brings in. It's really hard to hide that. And if you don't bring in enough revenue relative to the price of your stock, you're overvalued and more likely to go down in the next 3 to 6 months. So we use all those metrics and then create work lists. One is a large cap stock work list, S&P 500. Another is a small cap work list. And then we do the dividend dominators, where it's only companies that raise their dividend or that have a history of raising their dividend for at least 25 consecutive years, and some are nearly at 40 years and above. So that's cheat sheets, and you can go and subscribe to the free version or the paid version, and love to have you as a regular if you're not already. Okay, let's dive in. End of sales pitch. So the first thing we're going to look at is our the Wayne Gretzky, where's the puck is going. We don't want to skate to where the puck is, it's where it's going. And very clearly, after that little glitch in energy, remember we had those 2 big humps, one in February, another in May, and now we're starting to edge back up. So DBE, that's a commodity-based ETF that tracks 4 different fossil fuels and refined products. So it's U.S. crude, Texas crude, and it's Brent crude. It's home heating oil and natural gas. Those are the big 4 in the DBE. So it's tied to commodities. For those of you who aren't used to trading ETFs that are tied to futures products, because that's how commodities are traded. Just understand that before you go crazy buying and selling in that space, there's some extra tax paperwork that's required. You get K1 forms. And there can also be, depending upon the ETF, some weird issues involving the futures, which ETFs are better about this, but several used to be tied to just the front month futures contract, the one that was imminently going to expire. And what happens is that one tends to lose value as we get closer to expiration, unless the markets are in a very particular kind of scenario where spot prices are more expensive than future prices, but that's hardly ever the case. And so as a result, you have to be really careful with any of these commodity-based ETFs. As we get near a futures contract expiration, the ETF owner has to roll their holdings. That is, they have to take the futures contract that's associated, the one that's about to expire. They don't want to take delivery on barrels of crude oil, so they sell what ends up being a lower priced instrument, and then they have to buy replacement instruments for a higher cost, and that can be a drag on performance, which is why these commodity-based ETFs, you have to kind of read, you have to look under the hood a little bit. Now, many of them have solved the problem by being better about associating the underlying net asset value of the ETF to different, up to 12 months, some go even longer, different futures contracts. They diversify across of that, and it's less of a factor. So anyway, that's just my big preamble that says be careful about what you're trading if you don't know it, and understand it before you trade it. That said, there's lots of other ways to get at energy. We're using DBE sort of as that and DBC, which is a broader commodity ETF. DBC has about 40% energy ETFs, and then it's got base metals, meaning industrial metals, precious metals like gold and silver, and then also agricultural commodities. So DBC is a broader basket of stuff. DBE is energy focused, those four fuels. And together you'll notice that in terms of the relative performance, that is when we stack rank all of these different global ETFs that represent different international stock markets or asset classes, like we have BNDX down here, that's a bond market ex-US, or TLT, that's your 20-year treasury bill bond, TLT. So kind of a long dated bond. And then you have like QQQ, which is our tech heavy NASDAQ 100, and EEM, which is emerging markets. It's a lot of China and a few other markets. And then there is China, and there's the Dow and Japan, and EFA is the Europe, Far East, and Australia. So you've got all these different geographies and asset classes where we're comparing mostly stock indexes. There are a few bond indexes. And then what we're doing is we're tracking how price is performing relative to an underlying benchmark. And the benchmark that I've chosen is the IWV. That's the ETF that stands for the Russell 3000. And so by comparing how price is performing against the IWV, which each of these ETFs, we stack rank them. So if you're performing better, you get a higher number. If you're performing worse, you get a lower number. We are essentially, because we're comparing everything to the same universal benchmark, we are by extension comparing all of these ETFs to one another at different moments in time. And then we're trending that over time. So think of it like a baseball season. That's exactly what this is. So who's on a winning streak and who's been winning games lately? And then how is that affecting their overall season rank relative to other teams in the league? All right. So the way to interpret this is DBE over the last 10 days, 10 trading days, 2 weeks, there's no ETF in this stack for comparison purposes that's had better price performance. It's number one. Now, this doesn't speak to the magnitude of price performance, but we do that elsewhere. Okay. And DBC would be second ranked. It's the second best one, but only for the last 10 days. And that's the key. You want to be able to trend things across different look back periods because 10 days is not a lot of time. And in fact, I insist that I try not to make decisions about where I think the market is headed until I'm getting a snapshot that's roughly speaking 3 to 6 calendar months or 60 to 120 trading days. And that's what you see here. I call it the sweet spot. So when you see big transitions in relative strength or standings, going from worst to first or vice versa. When the significant change happens here, it means that there's a lot of different stakeholders that have had a chance to evaluate the situation and buy and sell things and make decisions. Because remember, the folks with the biggest bankrolls in the market, they tend to put their money to work over time. They don't just, not like us little minnows here where we can, we could probably fill our portfolio and be done in a day and not have to touch it again for a quarter, depending upon, what type of investor you are. With mutual funds and pension funds and sovereign wealth funds and others, hedge funds, others that control hundreds of millions of investment capital, they need to put their money to work over time. And so we can see rotation into and out of securities because, listen, the more money that goes to work against a particular ticker, the better price performance you have, right? The stock market is all about supply and demand. And so we're able to see rotation from red splotch to green splotch or vice versa, from green to red. And we think rotation is more significant if it happens within this sweet spot. So for example, DBE, it was strong after the Russians invaded Ukraine. It got stronger in the spring when the Russians made a lot of advancements down in a key part of Ukraine. Not that Ukraine is an energy producer, but Russia was kind of looks like they were winning, sanctions weren't working. And then all of a sudden, it looks like, between the release of strategic petroleum reserves here in the U.S. and demand slowdown in general, it looked like the price of oil has spent 4 months kind of in a decline. And that's kind of captured here. But lately, it's been performing better, up 5% on Friday. That's going to affect all of these time frames because these are all look back periods. We're comparing whatever that particular look back period is. Like, for example, where I'm pointing 60 days ago to today, right? Having a 5% increase on Friday baked into that look back period it's going to elevate the performance of lots of different look back periods. So the bottom line here is oil found its legs again, or this basket of fossil fuel connected futures contracts found its legs again. And it's persistently strong. So it was strong. It got tested. It stayed strong through our sweet spot here. Okay. So when you really want to see whether or not something has got some legs and is likely to be one of those where the puck is going, jump on the train before other market participants get there, first thing to look at is Chaikin money flow. This I also call on other cheat sheets, I call it buying pressure, but it's all the same. And basically anything above a 0.1 is bullish, and it means the stock is under significant institutional accumulation. The Investors Business Daily, maybe you haven't read that in a while. I used to, back when I actually touched real newspapers, I used to look at that all the time. They would use the Chaikin money flow as part of their system for what stocks were coming into favor. Big believers in relative strength and in money flow. So if 0.1 is bullish, well, 0.2 is colossally bullish. That's very bullish. That's my cutoff for that's significant stratospheric accumulation. And that's what we're seeing for DBE. Now, what's as important as the actual money flow snapshot is how persistent it is. And obviously we're not tracking that, but it's something you can look at on your charts. The longer these high levels of accumulation last, the more likely prices to go higher. And generally, you'll see a buildup in money flow. You'll see a relative strength transition. And then eventually, you'll see price keeps hitting its head against a certain intermediate to long-term resistance. And eventually the pricing pressure or the buying pressure just becomes so strong that pop, it gets right through resistance and breaks out. So put your eyes on money flow, then look for relative strength transitions in the sweet spot. And again, you can use this to trade bearishly. You just want to look for weakening relative strength and terrible money flow. And we've got plenty of that here. BNDX, for example, International Bond Fund. Man, it looks like interest rates overseas are going to go skyrocketing here eventually because they're dumping bonds and the relative strength is starting to fall. It's still early, right? It's not in our sweet spot, but it's coming. And so that's kind of one way to approach this is look for relative strength transitions where the money flow reinforces it. And the trend will usually follow those two things. So right now, DBE has always been in a long-term trend. Despite the 4-month pullback, it was not enough to upset actually, I'm sorry, my eyes are bad. That's the short-term trend. Yeah. So we're in a short-term uptrend. The 5 is over the 20 exponential moving average. Still have a hole in the intermediate time frame. That is the 10 exponential moving average. The 10-day exponential moving average is still below the 40 for both commodity ETFs. But the long-term trend, the 10-week EMA is above the 40-week EMA. So you're already in a long-term uptrend. Relative strength rotation in your favor, and money flow looks good, at least for DBE. Now, DBC, once you add metals, including precious metals, which are not doing well against the dollar, and agricultural commodities, some are on fire, others aren't, we have a neutral money flow. So clearly energy between these two is what's driving prices. Latin America, which I know I've said this will be the last time I say it, it's essentially an energy-centric fund. About 15% of it is Petrobras, and another 15% of it is a natural resources company. So 30% of this ETF is 2 companies. So it's energy and basic materials, essentially. And that is under accumulation as well. And then after that, you've got the IWM, which is trying to save itself, right? And again, it was bullish throughout the summer, right? We had bullish relative strength. It was the top performer of any of our asset classes, meaning U.S. asset classes throughout that 8-week summer rally we had. But then it started rolling over along with the other ETFs. It's rolled over less. It's behaved less badly than the NASDAQ. Certainly that's been the case. And the rotation has moved from 5 to 15th, and then we had 2 additional weeks of double-digit relative performance, and then we got a pop back up here on the strength of that bear market rally earlier this week. Excuse me. But none of this matters until we move into the sweet spot area. So when we start seeing single digits to double digits of bearish relative performance, and we start to see this money flow slip, that's probably when we're more likely to see IWM fall through this level. You notice it's not even nearly as down. It's not as close to the intermediate to long-term support level like SPX and QQQ is. But we still have some negative indicators. So anyway, this can help us conclude that we probably don't need to be loading up on straight shorts to the downside on IWM yet, because there's still some, even though the trends are terrible, there are still some indications that this thing doesn't want to go down, not at least without a fight. And so you go through that process, always looking for strong money flow to populate your bullish watch list, and weak money flow and weak relative strength to populate your bearish watch list. And then you'll armed with that information, you can turn next to the trading signals cheat sheets. And again, we provide both free at the global index level, at the US sector level, and at the subsector level. And then for individual stocks, that's where we get into the premium stuff. But again, we have some trading signals for DBE. This is called a stage 2 bullish progression signal. It's a standard trigger. Let me explain briefly how it works for those of you who did not listen to my audio embeds earlier this week. I'm going to go back to DBE. So think of this as a primer for this signal and this series of signals. So you notice we said stage 2. Yeah, the best way to use this is to break your money up into thirds. And this is a great way to climb the wall of worry, where you're putting money to work as the stock is earning your investment through improved performance. So we start with the lowest tranche would be a stage 1 trend progression signal. That's where this intermediate market forecast line moves from below 20 to above 20, which it did around October 3rd. How do I know? Because I traded XOP, which did this, basically had the same trading signal at the same time. So stage 1 is when this green line moves from below 20 to above 20, while the near-term line moves from below 80 to above 80. And that's what happened for a confirmed stage 1 trend progression signal. Then a few days later, price continues to move higher. And it looks like we just had this happen on Friday. This green line, the intermediate line, I'm going to show this to you on cheat sheets, moves from neutral plus or weekly bullish to bullish. So we move from very bearish to neutral plus, crossing 50 to very bullish, to bullish, excuse me. And that was confirmed again by having this line above 80. So the near-term forecast above 80, the intermediate forecast above 50. So that is called a standard trigger. And here it is in cheat sheets. So I got so many damn windows open, don't I? So DBE. There's your intermediate forecast. It was neutral plus. It moves to bullish, confirmed by a very bullish reading above 80. You notice that I've changed this to highlight the extremes and the junior time frames. And there you get a bullish standard trigger for an intermediate stage 2 progression. And this would be if you were following along this system. Let's suppose you're willing to put $1,200 to work. You would have put your first 400 to work on a stage 1 signal, your next 400 to work Monday when the market opens, provided it doesn't open disastrously. And then it would have to earn a trip up through 80 for stage 3. And that's here. Stage 3 would be this oscillator moves to its most extremely bullish point. And if it does that and it gets confirmed by this blue line above 80, most likely will break to a new high. That will likely confirm a breakout if we get there. And there looks like there's some momentum here. Now, there's not a whole lot of volume. And again, this is a light volume ETF, but I'll show you that the XLE looks just like it. And this is a high volume option trades work here. And XOP, which is oil exploration and production, and even OIH. That one looks even better. OIH is almost broken out. So the energy services and oil exploration and production companies look actually better than the commodity itself. So all of these signals are doing the same thing. And that's how to trade a trend progression. And the good news is at some point we may just flatten out, or it could be a fake out rally. Worst case scenario, it's a fake out rally. And then instead of losing 100% of the risk capital that you allow yourself to lose in any one trade, you're only losing a fraction of it because you're making the stock earn its investment through a series of successive moves through key momentum metrics. And that's what I like about that signal. And that's why we captured on cheat sheets. All right, so then there's buy the dip. Now, I'm not going to buy the dip on ILF, but it's just good to know that the Latin American energy and basic material centric ETF is trending and gives us a buy the dip signal. So a few things. You most certainly want factors 7 and 8 to be in agreement whenever you're talking about a buy the dip, especially when you don't have universally established trends. For example, right now, the ILF, the 10-week moving average is below the 40-week moving average. And even though we're in an intermediate uptrend, meaning the 10-day moving average is above the 40-day moving average, just that dichotomy alone, we need more data to feel like we have an edge, because the trade could fail as easy as it could keep trending. And so we like more data to feel better about this position. Well, the fact that tailwind score is a 69, anything above 50, for those of you who don't want to do the deep dive into the minutia here, above 50, you're in better shape. Below 50, stay away. And then you can use a trading signal that you like and just be above 50. But the things that I look for when I'm considering a trend following trade, which a buy the dip signal implies that you're following a trend, right? And you could do the same thing. You could break your capital up into halvesies, or even a third, and successive buy the dip signals will earn additional incremental investments. So you're sort of dollar cost averaging on the way up. And that is a strategy that I like to use. So for buy the dip, I want these two timeframes to be in agreement. And my preference is for the intermediate trend to be established as at least bullish. All right. Now the buy the dip signal starts kicking in if the intermediate market forecast, remember, these are all on this side is forecast oscillators. Here are the actual trends. These are forecasting trends. And I want the intermediate oscillator to be at least bullish. The good news is this one's very bullish, meaning it's above 80 on the intermediate oscillator, but I like it to be above 50. I think it's a little bit risky, particularly in a bear market, to rely on buy the dip when the oscillator is only moving above 20. So let me go back to the charts just to show you what I'm talking about here. We'll dial up ILF. All right, so here we are below 20. Let me get rid of a lot of indicators here. Well, I gotta keep this. Sorry about this. I don't really trade this ETF that often, but here we are at our most bearish position. We're below 20. But on this big gap day, we trended from 15 to 29. And so that would have been a stage one intermediate trend progression. It actually almost became an intermediate trend progression with a strong signal. Notice that both the red and the blue line, meaning the factor 9 and factor 10, were both above 80, but we wanted this red line to get above 90, and I don't think it did. Oh, it came so close. Yeah, maybe it did. 89. I probably would have said tie goes to the runner. So this would have been a strong entry signal, a huge gap up, confirmed by two different junior time frame oscillators above 80 and nearly 90. I'm going to call it 90. So that's a strong trend progression signal from very bearish to neutral plus, meaning mildly bullish. Then we got our second intermediate transition really on the next candle, which was another gap higher. It looks like trying to get through resistance, hanging man pattern. So we expected there would be some settling after that, but we did get our second progression signal. And then just by going sideways, because of the momentum we had, we actually moved even above 80. And while all this was going on, the long-term market sentiment, meaning still in agreement with the shorter-term market sentiment, meaning the intermediate time frame and the longer time frame, are both strongly bullish. This is above 50, this is above 80 now, going back to ILF. Here on the charts. Oh, I must have the weeklies up here. No, I got the dailies. I might have to check this and make sure I've updated this because this doesn't look right to me. Oh yeah, okay. Neutral 10 to 90, neutral 20 to 50. Let's see if that's right. Yep, that's right. 20 to 50, 10 to 90. Okay. Yep, we're good. So we're above 10, below 90, neutral on the momentum line and neutral on the blue line, but very bullish on factor 8, the intermediate time frame. Sorry, I know I'm making you nauseous. There we are, very bullish, above 80. And notice that we're above 50 on the factor 7, the long-term market sentiment. So these two in agreement means the trend is, we have high confidence of the trend continuing. And then neither of these pulled back into dangerous territory, hence buy the dip. So here's specifically what's required for a buy the dip signal. And remember what I said, I only like taking buy the dips when that green line is above 50, meaning it's on the offensive side of the field. It's an oscillator, so the closer you are to 100, the stronger the momentum. I just want to be above 50. And then what we want is light volume pullbacks. So the red line, factor 10, we don't want it to go any lower than 5. So as long as it hangs out above 5, we're good. This blue line needs to get down below 50, but it shouldn't get any lower than 20. And when you have, so you have these oscillators screaming to the upside and these pulling back, but not deeply, that sets up your buy the dip signal. Now, I really like it when buying pressure, AKA money flow, is bullish or better, which we're getting here. So in summary, a really good buy the dip signal is when either we have at least factor 1 or factor 2 bullish. One or the other has to be there. We need some kind of uptrend, okay? Because otherwise you're buying the dip in, but what's trending? Number 2, buying pressure. A neutral plus is okay. That means Chaikin money flows 0.05 or better, but bullish at 0.1 or very bullish 0.2 or better, that really sets you up for high probability. That would be the second kind of immutable rule that I have. The third immutable rule is factors 7 and 8, both in bullish agreement. And all I care about is agreement, meaning this could be neutral plus, which is our way of describing something that's mildly bullish. So the long-term sentiment could be above 20, but below 50, which would be neutral plus trending higher, or above 50, either one. And then the intermediate forecast, I do prefer that it be above 50, meaning bullish above 50, very bullish above 80. So in agreement, and this one above 80, and then these two oscillators pulling down under 50 and below 20 respectively, but not below 5. And if you do that, then you've got a really high probability of the trend continuing. Now, DBC flashed a intermediate trend progression signal, but its metrics aren't as strong as DBE. Okay, so that's how to trade those two signals. I'll speed things up a little bit. Let's take a look next at U.S. sectors. We're going to see basically a bifurcation. There's only one thing bullish in the U.S. stock market, and that's energy related. And it looks just like the commodity. And you saw the chart looked better. So we're up in multiple time frames, short, intermediate, and long-term trend already established. Now, money flow is not that great. So that's a little concerning. We'll have to watch that. But you would I guess overall, there's just not a very big appetite for equities right now. There's a lot of market participants just in cash in general right now. They're very scared about the next one. You know, we break this level that we've been at for 4 months. We break that, it's going to be a break. And I think that's probably why you're seeing that money flow. It's neutral, right? So it's a little below zero, but it's not even below 0.05, negative 0.05. So between negative 0.05 and positive 0.05, that is straight up neutral. Okay, there's no buying pressure or selling pressure going on to speak of on XLE. But we'll want to watch that. A trend is only as good as the weakest link, and you want FOMO. And in a perfect world, you want FOMO buying. And we're not getting that here, but we're getting a solidly trending set of metrics. And let's just put ourselves in perspective. Where are we on XLE? Because at the end of the day, the price chart does matter. So yeah, we're going sideways, and we have been for months. And we're kind of coming up to a critical level of resistance. Now, this market forecast is saying we're probably going to break out. We're getting set up for an intermediate trend progression stage 3, right? Blue line above 80, and this green line needs to cross above 80. One more up day, and we've got it, and this will confirm the breakout. We may actually throw back, bounce off 77 and take another run at this before we're done. One of my favorite ways to look at these types of breakouts is to remind myself to connect the previous two shorter term highs. And so this was our actual breakout day here. And so we're very likely to come back to 80, do a little throwback retest and bounce off of diagonal resistance, formerly acting as resistance, should act as support. I call this a valley, peak, valley reversal. So we've been in a bit of a downtrend, short-term downtrend in the context of a long-term sideways trend. We busted through diagonal resistance. We need a light volume pullback to get to between 79 and 80 and a bounce to a new high, and that would correspond with a breakout above this level and then eventually above here. And so the market forecast is pointing that way. Nothing's guaranteed, and some traders never like to get involved in a trade pre-breakout. My point is that's why I use the market forecast, right? It's all about skating to where I think the puck is going, and I don't mind anticipating short-term breakouts. Now, it's a different story when it's a series of 4 different monthly candles that have all tried and failed to break through monthly resistance. I mean, this is just short-term stuff. So I'm okay with it. Okay, so you'll see there's not much else besides energy trading here, and there are no signals to speak of at all. Down in subsectors, in terms of relative strength, again, the exercise is start with your eyes over here, look for the dark green. That can be a watch list. Innovative tech. I noticed that the relative strength trends don't look good at all, but I noticed software and services and innovative tech and like server-based tech were showing, yeah, there's innovative tech down here. No, that's just regular tech. So that's like your classic Cisco systems type tech. But a 0.22 is significant accumulation. And then up here, this is our innovative tech. So these are going to be your disruptive stuff. So the money flow is not bad there. I'm not sure what to make of that. And pharma, there's some big blockbuster drugs in the pipeline. Eli Lilly has apparently a phase 3 obesity drug where study participants are losing an average of 20% of their body weight. There's another Alzheimer's drug in, I think, earlier phase trials, but where they dissolved myeloid plaques off brains and actually got the brains to function better, like 27% better. So there's some stuff happening in pharma, and pharma tends to be it's sort of pharma and biotech tend to beat to their own drums because even when you lose your job, you still have to take your diabetes medication, right? So they tend to be a little bit more insulated to market corrections, and so it would be a good idea to when you see accumulation numbers like that, and then you see relative strength patterns that are a little inconsistent, right? We had a big push, a fallback. So this is actually technically in the sweet spot, a move from 3rd to 16th because we don't count anything over here. So pharma is actually potentially under district, is rotating out of favor. But of course, we then are going to be, we're 1 week away for having single digits kind of rotate back into this space. So I guess pharma is oscillating, and it's done it again here, moving from 5th to 9th. We need to see, a series of 5 or 6 greens in a row. So this looks like it's really early XPH, but it would definitely be on my watch list, especially with a 21. And innovative tech is even, there's no rotation going on. It's one day. Right now, it's just bearish. Yeah, bearish trend, bearish relative strength, and at least some money flow. So you got to start somewhere. I'd watch that. KBE banks, they had been persistently bullish, and then they got whacked this week. And then down here, capital markets, KCE, not much in the way of relative strength or trend, but I guess brokers are going to make money because people are buying the rips and selling buying the dips and selling the rips, right? RWR looks really bad though. That's the one, you got a bunch of neutral, slightly negative, neutral, and some positive. This, by the way, doesn't look like this type of money flow configuration doesn't look like a crash to me. It looks like a fight at the current support level that we're at. Real estate looks like a crash. RWR, look at that. Relative strength is terrible. Multiple different time frames of downtrends and a liquidation rate below negative 0.1, closing in on 0.2, negative 0.2. RWR, I'd be looking at only short trades for that one. And there you go. Look at that. It just broke on Friday. Broke this low. And let's see what it's connected to. Well, it broke this low even more significantly. It's just been crashing. So getting closer to its price target, there'll probably be a little pause at around 75. That's about a $6 down move from there. And then 66. Yeah, eventually these guys are gonna make a $15 move to the downside, most likely. It won't all be at once. We've got market forecast coiled up like a spring. This is called a cluster. This is a reversal pattern. I don't capture this on cheat sheets, but it's one worth knowing about. Generally speaking, after a cluster is formed, when it's the first one of a downtrend, maybe, it's the second one. Yeah, there's a good chance we'll reverse here. Now, the sentiment line on the weekly basis is the long-term sentiment is really pretty bad. So it's not likely to be a trend reversal, but this is setting up to be a big bear market snapback rally, probably to diagonal resistance. So there'll probably be a big whoosh up and then a fall lower. That would be basically what this market forecast is suggesting. In any event, these clusters, when you have all 3 timeframes clustered below 20 or above 20, what you wait for is the green line to move from below 20 to above 20 as a intermediate stage 1 trend progression signal. Probably treating it as a swing trade rather than a trend trade because of this. But that's a good trade. The cluster trade does work out about 65 to 70% of the time. So you're trading counter trend and just setting a price target at a reasonable to attain resistance. All right, we're getting close to the end here. Some trading signals. I'm not going to repeat anything, but XOP did make a different type of trading signal. This is a medium-term entry signal. It's moving average crossover. It's a daily moving average cross of the 10 over the 40. Just a couple of things. You've got the intermediate and long-term market forecasts in agreement, senior timeframes in agreement. You have some bullish confirmation in the near term. So this crossover got you some near-term bullish love above 50, not above 80. That would be better, but at least above 50. You've already got the trend as your friend in multiple timeframes, and you have a great outperformance versus the market and just so buying pressure. So once again, we're not seeing a FOMO rally on energy stocks, on any stock, but fairly good bullish metrics, and a 74 tailwind score is about perfect, right? You don't want the tailwind score to be too high because it means that we will have maxed out too many of our metrics and there's no place to go. So XOP, the intermediate crossover play. Let me show you the moving averages that I like to use for this one. So I'm a little skittish about this type of market. Let me show you the signal and then how I would manage it. So here's the signal. This is the 10, the green. This is the 40. You can see when we're in bearish sideways markets like this strategy tends not to work as well as when we're bullish, right? And so I'd like to see that FOMO number. We need something to give price a push and not just a push for 2 weeks and then an oscillation back lower. So since the bear market began, we really haven't been able to pick up any steam. So I'm not sure I would take this trade given the sidewaysness of it. And especially since we've been running, and there's probably a good chance we'll throw back and retest and maybe bounce off the 40-day moving average. But my guess is that's what I would be using as my support lever is this red 40-day moving average. So I'd want to get right for 142 now. I'd rather see a bounce off of 135, 136. And then to manage it, I'd come over to my 40-period moving average and I would slap on a Keltner channel. That's what this dotted line is below it. This is a 1.1 times the 40-day average true range of this stock. So in other words, the trading range, an exponential average of the last 40 days of trading ranges averaged together and then stuck under the 40-day moving average. So that's pretty wide right here. So I probably wouldn't be trading too many shares. I want to see this thing get back down to 135. And so I'd be out at 128 and I'd want to trade this thing as close to 135 as possible and give myself a little bit of wiggle room to the downside, but not a lot. I need to see that buying pressure better. I've got relative strength. I just don't have buying pressure. And as a result, I've got a sideways trend. So this is good, but not great, but it looks like energy is going to move. All right, so existing trade update. And by the way, in Substack, you have the ability to elongate these things by clicking on them. So you can see, I'm going to put this out to full width so you can see it. But just a couple of updates. You asked me to start tracking some of my trades. So these are from last week. We put these on 10/3. This is PST. So this is the inverse 7 to 10 year treasury. And we position sized for either 10% of a $100,000 portfolio or a 1% trade loss, whichever came first. In other words, we'd buy the lower amount of shares comparing those two because we don't want to invest more than 10,000, not more than 1/10 of our, maybe it's even 1/5. I can't remember. I'm sorry, 1/20th. I think it's either 5 or 10% as the total amount that you'd allocate toward the trade. And then when you look at your entry price and your planned exit, your stop loss, and you multiply it by the number of shares, you don't want to lose more than 1% of your total account value. And so that's called fixed fractional something position sizing. In any event, it's a way to keep you from oversizing, especially in a bear market. Remember, stop losses, particularly on big down days where the market starts lacking liquidity, a stop loss is nothing more than a trigger of a market order at a specific price lower. So as if the market trades down 10% overnight because of some horrific thing that happens over in Ukraine, and your stop loss is maybe 3% lower, there's a very good chance you won't get out of that stock until it opens 10% lower. So keep that in mind. The only way to control against that is to keep your position size reasonable. Can you recover? Your losses if everything in your portfolio were to stop out in one day? And so the reason I use 1% is I generally like to have 10 positions on, for diversification purposes, each of which I'm willing to lose up to 1% of my portfolio. And so if I got stopped out of everything, If I had a $100,000 account and the market just collapsed, it would mean I'd be down theoretically, provided none of the weird liquidity issues that I just described happen. I'd be down to $90,000. I could easily recover from that, right? 10% gain in a stock market is fairly typical after a bear market. May not be for a while, but I could get back from that. But a 50% drawdown, well, that's a whole nother ball of wax. That takes years to recover from. So you want to be really careful about position sizing. So I have a little spreadsheet. Then if you're a premium subscriber, I'm happy to share it with you, so you can size your trades if you need help. So 449 shares. We entered at 21.94. Our exit was planned at 21.44. That, just so you know, is 3 ATR below our entry price. That's what I decided to do with that one, a 3 ATR stop, meaning 3 times the average trading range of the stock for the past 5 days, I should mention, below the price of shares where they're at any given moment. We never move the stop down, only up. So our current stop loss is set to 21.51. Our unrealized gain so far is 255 and change, and we've made 2.6% in a week. And that was a buy the dip strategy. The other one is, our intermediate trend progression signal on one of the energy stocks. It was XOP. So I guess I probably should take a intermediate trend progression signal 2, if that existed for XOP. No, it didn't. It's a different type of signal. So I missed it, I guess. But XOP stage 1, we've been over what that signal is like. Bottom line has made $718, about an 8% return in a week. Not bad for a stock trade, profitable so far. And I'll look to move my stop losses up before the open tomorrow. All right, finally, if you have not yet subscribed to the free version of Cheat Sheets, I highly recommend that you do it this weekend. You don't need to subscribe to the paid one, because I'm doing a little bonus for every subscriber, whether they're premium or not. I just worked up my list of a little bit south of 30 S&P 500 stocks that have what I think great fundamental metrics, so that when and if the market reverses, these guys mostly are already in an uptrend, a lot of them with neutral to very bullish money flow and relative strength trajectory starting to kick in. But this watch list has nothing to do with technicals. This is all about fundamentals. So price to sales ratio is a key driver of this list. Undervalued stocks only, stuff that's gotten beaten up. Number 2, management with a history of making earnings performance. Number 3, analysts raising estimates into this downturn in the market. Number 4, must have either cash flow, meaning it can't get away with not making money and being on this list. And finally, and this is an or, if there's heavy insider buying, what do they know? So that's my criteria for this. So it's a really good, mostly Warren Buffett list, which means that you want to be sure that you're looking at the timing to go with it. And that's why I provided this to you as a watch list with relative strength. And then for premium subscribers, you're going to get this tomorrow with trading signals on it. Okay. Sorry, I can't give up everything to the non-paid folks, but it's plenty of stuff. But I'm hoping that you really enjoy this. It's probably no surprise to you. What's working is refiners, ExxonMobil, which has multiple streams of revenue from refining to exploration and equipment services. ConocoPhillips, Marathon, which are refiners. There's PXD, Pioneer Natural Resources, that's pulling stuff out of the ground. There's so much need for lithium and other rare earth metals, and China's cornered the market in a lot of that. So there's only a few companies in the U.S. that produce some of the key minerals we need. So between basic materials and energy, that's going to be a lot of this list. But it does appear to be that there is some of that innovative tech down here. TMUS has been a great stock. I traded that most of the fall. Humana, so there's some healthcare services in here. DR Horton, some home builders, terrible relative strength right now, terrible trend. But remember, it's about when the market rebounds. This is just a work list for when and if we get that explosive move off the bottom. And that will probably happen after we have a capitulation move first. All right, this has been a kind of long-winded, but hopefully you got something out of it. It's going to be a big week, and I think the market's going to move around a lot next week in reaction to inflation data. My expectation is we're going to be disappointed by inflation data. It's going to be too hot, and the market will probably break support. If you want, that's what I think, and that's about as valuable to you as a U.S. penny is. So not very valuable. What is valuable is cheat sheets, which will give you data to make informed decisions. I'm Mike O'Connor, and thanks for listening, and we'll talk to you soon. Once I figure out how to shut this fucker off. I will figure it out. And broadcast. See you guys.